Ladies and gentlemen, good day and welcome to the LIC Housing Finance Q1 FY26 Investor Conference Call hosted by Axis Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Praveen Agarwal from Axis Capital. Thank you, and over to you, sir.
Thank you, Manav. Good day, everyone, and welcome to this earnings call of LIC Housing Finance. From the management team, we have Mr. Tribhuwan Adhikari, MD and CEO, and Mr. Lokesh Mundra, CFO, to take us through the key highlights of the results, post which we'll open the floor for Q&A. Over to you, Adhikari, sir, for your initial remarks.
Yeah, thank you, Praveen. Good morning, friends, and welcome to all of you to the post-earnings conference call of LIC Housing Finance Limited. As you are aware, LIC Housing Finance declared its Q1 FY26 results last Friday. Before I start the highlights of the Q1 results, I would like to outline the few developments in the economy over the quarter. In its June 2025 MPC meeting, the RBI surprised the markets with a 50 basis points repo rate cut, bringing the policy rate down from 6 to 5.50%. And also shifted its stance from accommodative to neutral. Also, 100 basis points CRR reduction was announced, which was expected to inject approximately 2.5 lakh crore of liquidity into the system. The company, keeping in line, also reduces rates of interest on new home loans by 50 basis points with effect from 19th of June 2025, coinciding with the company's 36th foundation date. New home loan rates now start at 7.50, which is very, very competitive. The banking system continues to enjoy a surplus liquidity position, amplified by the CRR cut, and this made availability of funds to HFCs like us, I would say, in abundance. With this, we present the financial highlights of the company for the quarter, which is as follows. Total revenue from operations was 7,233.13 crores as against 6,783.67 crores for the corresponding quarter of the previous year, up by 7%. Outstanding loan portfolio stood at 309,587 crores as on 30th of June 2025 against 288,665 crores as during the same period of last year, reflecting a growth of 7%. Individual home loan portfolio stood at 262,411 crores as against 246,275 crores, again up by 7%, and comprising 85% of the total loan book. Total disbursements for the quarter were 13,116 crores as against 12,915 crores. Out of that, disbursements in the individual home loans were 11,247 crores as against 10,932 crores. Disbursements in project loans were 156 crores as against 521 crores for the same period of last year. We have seen disbursements pick up gradually during the latter part of the first quarter and in the month of July. Net interest income stood at 2065.78 crores for Q1 of FY26 as against 1989.08 crores of Q1 FY25, up by 4%. Net interest margins for Q1 stood at 2.68% as against 2.76% of Q1 of FY25 and 2.86% of Q4 FY25. PBT for the quarter was 1699.16 crores as against 1628.43 crores in Q1 of FY25 and 1769.58 crores for Q4 of FY25. PAT for the quarter stood at 1359.92 crores as against 1300.21 crores for the same period of the previous year. In terms of asset quality, Stage 3 exposure default as on June 30th, 2025 stood at 2.62% as against 3.30% as of June 30th, 2024. Total provisions as on 30th of June 2025 stood at 5051 crores, reflecting a provision coverage of approximately 51%. As against 50% during the same period of last year and 51% of Q4. A technical write-off of 30 crores has been made in the quarter. On the funding side, our cost of funds stood at 7.50 as on 30th June 2025 as against 7.76% as on 30th of June of last year, and 7.73% as of 30th of March 2025, reflecting a reduction of 26 basis points YOY. Our incremental cost of funds stood at 6.97% for Q1 of FY26 as compared to 7.66% for Q4 of FY25 and 7.82% for Q1 of FY25. All in all, the first quarter of the financial year has been quite flattish, if I may say so. But we are seeing traction moving forwards, and as is usually the case, Q1 is a bit slow. We are a bit slow to take off, but we are very confident of accelerated movement happening in Q2, Q3, and Q4. With this brief introduction, I'd like to invite you for your queries. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets only while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have a first question from the line of Maruk Adajania from Nuvama Wealth Management. Please go ahead.
Hello, sir. Hi. So, I first had a question on credit cost. So, our guidance was 9 to 15, right? And our credit costs are much higher than that range this quarter. How does it pan out going ahead? Because recoveries don't seem to be coming through in the way we had envisaged. And anyways, a lot of people are reporting, however small, some incremental stress in asset quality. So where do we stand on that front? That's my first question, and then I have others.
Okay, Maruk. As regards the credit cost for Q1 of FY25 is at 5 basis points, right? And if you compare this for the whole of last year, it was about 9 basis points. Yes, I do agree. Like others, we are also witnessing some pressure on the collection efficiencies. There is a slowdown in the month of June. But we are not worried because by and large, our June quarter is slow. Largely because we here in LIC HFL during the months of May and half of June, I would say first half of June, this is the promotion and transfer season for all of us. So there is a lot of movement of personnel from place to place and from vertical to vertical. So that does dampen the kind of effort and the focus that there is. So we're not worried that the guidance which we are given for the credit cost, I believe we'll be able to maintain it going forward. There has been a slight increase in provisioning as well as a slight increase in NPAs. NPAs have gone up by about 500 odd crores during the quarter. But we are not worried. I think we can recover that. We are seeing signs of recovery already in the month of July. Now that all my personnel or my resources are settled down and in place, have taken over their new positions, new postings. So we are, I believe in Q2 and the later quarters, we will continue to do well like we've done last year. Of course, there have been no big resolutions this quarter. Many sort of big cases are in various stages of legal recourse and discussions and negotiations. So hopefully looking forward, I think we could look forward to resolution of one or two big cases which would considerably impact our credit cost and our NPAs and provisioning, of course.
Yes, sir.
So you just see the last year Q3 and Q4. So that time the credit cost was negative in Q3. That was negative by 0.07%. And in Q4 it was just 4 BPS only. So in totality last year it was 9 BPS. So definitely what our MD and CEO is saying, so we'll maintain our credit cost within the limits.
Sure. No, what I meant was that if you annualize that 192 crore of provisions, then it works out to 25 basis points. But anyways, so what was the... Sorry.
Yeah, it cannot be like that. It's not like your interest cost, you are just multiplying credit cost of one quarter by 4. That is not the correct way. So if you just compare with the last year's figures, so in Q3 it was negative, and Q4 it was just 4 BPS. So I'm sure that in the coming quarters it will come down.
Because of recoveries?
Yeah, for recoveries.
Okay. And so what was the softness? You said there was some softness in June. In which pockets? Means in general.
It was basically in the retail segment, Maru. It was basically in the retail segment. So whatever NPA increase we have seen, 500 crores as I said, it was mostly in the retail segment only, and that is where we are seeing some pressure on the collections. But I believe it's nothing worrying, and I think going forward this can be made up. We have intensified our recovery operations. Yes, a part of this loosening or weakening, if I may call it, was due to movement of personnel and posting of new people into these verticals, recovery verticals especially. But that is taking place now.
Sure. And July has recovered?
Yeah, to some extent. Of course, it's not huge. But yes, to some extent, it is much better than what it was in June.
Okay. And so just on growth then, the disbursal growth is soft this time. I'm talking about YOY, not QOQ. So how do we scale it up from current levels? Because competition is also intensifying, and I'm told that PSU banks are now trying to compete across segments, and their rates are also very favorable. So in that context, how do we build up?
Yeah, true. As far as the competition is concerned, competition is intense, and unfortunately, LIC HFL, we are competing with banks because we are mostly into the prime segment into which banks are. So yes, there is a lot of competition. There is a rate war going on, and literally, of course, as far as the rates are concerned, we have also come down to the bank level. So we are offering loans at 7.50, which most of the bigger banks are offering. Yes, there are some smaller banks which are giving loans at even lesser than that. So yes, competition, of course, is there and is expected to be there in this segment also. The other part of it, why I would say growth in disbursement was slightly low in Q1, partially the rate cuts of February to April, 100 basis points. And if you must be knowing, banks are directly linked to the repo rate. The lending rates of banks are directly linked to the repo rate. So as soon as there is a repo rate cut, the rates automatically get reflected, the lending rates by the banks. Unfortunately, we have unfortunately or fortunately, both ways I would say, we are linked to a PLR, not to the repo. So we have to take a call on what to do with the rates as and when the rate cut is there. To some extent, I do agree. I think we were slightly delayed in lowering the rates. The banks cut it immediately. Of course, they had to cut it immediately since it was linked to repo. We took our time, slightly probably a little bit more time than what should have been. So that was one of the reasons. And the other reason I personally feel people in India are smart. I believe they are all aware that there is a cycle of reduction in rates going on, and maybe waiting for the cycle to finally conclude or come to some finality before they take a call of entering the thing. So yes, there was a slight, I would say, a lesser demand than what was expected. When the rates were cut, we were expecting a huge boost to the demand. That did not happen, and that was witnessed across the industry. But hopefully going forward, I believe they should pick up, and of course, our movement of personnel and people, that also has an impact in the disbursements in Q1. And as I said, that is over. So Q2 in July, there has been better growth. We have done better in June than in July. So going forward, we do expect these disbursements to go up.
Okay, sir. Thank you. Thank you.
Thank you.
Thank you. We have our next question from the line of Avinash Singh from MK Global. Please go ahead.
Yeah, hi. Good morning. Thanks for the opportunity. So, a couple of questions. The first one is now, as RBI has cut 100 basis point repo rate and the housing loan interest have gone down. So, my question is that, on your existing book, that is largely, I mean, a floating rate, the individual loan, how much of that book has been repriced and how much is yet to be repriced? So basically, assuming that, I mean, the rates stay where it is in the repo rate, what kind of a yield side compression you see over, I mean, the next 2 quarters? And given that your borrowings are also repricing quite fast this time, what kind of overall NIM compression do you see over the next, say, 2-3 quarters?
Yeah. Avinash, as far as 100% repo rate has been cut, and you've said that the cost of home loans have gone down everywhere, and that's not true. Public sector banks have done it because they are linked to the repo rate. They have no choice. They have no alternative. But if you look at the NBFCs and HFCs, as far as I know, from my personal knowledge, apart from LIC Housing Finance and Fin Homes, nobody else has cut rates. HDFC maybe to some extent, but others are where they were. Yeah, the cost of borrowing, I think, has gone down to some extent, but for the existing borrowers, they continue to remain where they were. As far as we are concerned, we have cut our rates by 25 basis points for existing borrowers also. This came into effect from 1st of June. And now, since our loan book is comprised of loans with monthly reset and quarterly reset, approximately of 1/3 of our book has already been repriced. The remaining 2/3 gets into repricing from 1st of July. So that will have some impact on our, I would say, the yield on advances. Now, if I talk of yield on advances, the incremental yield on advances has come down by about 50 basis points from 9.4 at the end of Q4 of last year to 8.9. And cumulatively, it has come down by about 19 basis points from 9.79 to 9.60. Comparatively, if you look at the incremental cost of borrowing, the incremental cost of borrowing has come down by 69 basis points from 7.66 to 6.97, and the cumulative cost of borrowing has come down by 23 basis points from 7.73 to 7.50. So whereas there is a compression in the yield on advances, there is also a compression on the cost of borrowings. Net, I do not believe my NIMs, which are at 2.68 as at the end of Q1, I don't think there'll be too much of a deviation in the NIMs. Whatever compression is there in the yield on advances will be offset by the compression in the cost of borrowing.
I also want to say, so if you compare our spread now, you'll realize that our spread has increased by 4 BPS. So now it has 2.10%. If you compare it with the previous quarter sequentially, so it's for 2.06%. So we are getting more benefit in the cost of borrowing. So incrementally, it has come down by almost 69 BPS. Okay.
Yes, sir. Yes, sir. Yes. In fact, that's why I saw that spread increasing, and that's why my question was that your peers are largely the public sector bank. Your competition is largely private sector bank, public sector bank. And in that context, my question was more that the 25 basis point cut you have kind of done on your existing portfolio, where what the MD said that 1/3 portfolio has been repriced and the rest will be repriced over time. My question was more that, okay, is this 25 basis point cut makes your kind of offering attractive enough to kind of control balance transfer, or will you be required to kind of bring in more cuts? So, is this 25 basis point cut sufficient, or will you be required to kind of respond with the higher cuts? Thanks, because your competition is public sector banks.
Yeah, true, Avinash. Competition is public sector banks. As of now, we have taken the call of 25 basis point cut across the board. As of right now, we are not contemplating any further cuts. Let's wait and watch. There is not too much of an impact on our, let me say, BT. The BT, yes, they have gone up slightly, but it is not, the increase is not significant for us to get into panic mode and start cutting immediately. So right now it's wait and watch. We are waiting and watching. BT is at manageable levels, and I think we need to watch what happens over a period of time. And if required, I'm not saying no, if required, yes, we may be required to cut again, but I think we would try to manage our portfolio within the existing levels of rate cuts, whatever we have done.
And Avinash, we are also hopeful that in the coming quarters, our cost of borrowing will further come down by 5 to 10 BPS. And our fresh loan rates, it starts from 7.50% onward. So it is in line with the other PSU banks.
Okay. Thank you, sir. Thank you.
Thank you. We have our next question from the line of Rishabh Seth from Karma Capital Advisors. Please go ahead.
Hi. Sorry. No, my questions are answered. So thank you so much.
Thank you, Mr.
Thank you. We have a next question from the line of Vansh Solanki from RSPN Ventures. Please go ahead.
Hello, good morning, sir. Actually, I have questions on project finance growth. So if we see in this quarter, it is quite muted. So is the LIC Housing Finance want to grow the project finance or both? And how the management is seeing growth in that sector? And also, if you see the overall growth, it is almost a stable, same as the Q1 of 24. There is no growth, you can say. So, what are the in market and what do you say about this?
Yeah, Vansh, yeah. It is not that we are withdrawing from the project finance market or the construction finance market. We are there. Yes, we are slow because we want to finance only reputed and builders with pedigree. Our past history, as you all know, in the project finance space has not been great. There was a point when 54% of the construction finance book was NPA. So we have recovered from that. Learnt a lesson, and we are going slow. But we are definitely there in the project finance market, and we want to grow our books. As to why the project finance disbursements were low in the quarter, if you understand project finance, the disbursements are not like retail loan where you sanction a loan and immediately the loan gets taken off. The project finance are there. We have sanctioned about 800 crores of project finance in Q1 of this current year. But the disbursements are linked to stages of construction, right? So over a period of time, as the project starts getting constructed, the disbursements will happen. So I'm not worried. Yes, 156 crores of disbursement as against 521 crores does appear to be some kind of a shocking downfall, but it's not worrying. It's not worrying at all. We are into the project finance book. We are assessing, appraising loans to credible and at least BBB rated builders, and we are hopeful for recovery in this. Already 800 crores have, as I told you, these would be disbursed as and when the construction happens. And there are various other loans which we are assessing at the moment and would get disbursed in the current quarter. And offtake would happen in some of it in the current quarter and some in the quarter 3.
Okay. And the second question is on my liquidity. That is there any excess liquidity at the end of Q1 with us?
Our liquidity, no, I think we don't have any such liquidity because our borrowings are exactly linked to what we need or what our requirements are. So maintaining liquidity would be a cost. We are very calculative as far as how much we need to borrow, and that is linked to our internal approvals as well. The kind of disbursements we expect to make over a period of overall, the liquidity in the system, we see, there is, I said in my opening remarks, the liquidity in the system is there. The RBI, the steps taken by the RBI have improved liquidity in the system, and there is no constraint or any, I would say, difficulty in raising loans and advances from the market. Funds are available and all it. The only question is at what rates they are available, because we are negotiating whatever benefits we can get, as have been witnessed by our. We wanted to come down further, as far, and we are seeing a good traction. Just for example, very recently we borrowed 2,000 crores at 6.75%, whereas our overall borrowing cost is at 7.50. The incremental borrowing cost for the quarter is at 7.50. So hopefully, going forward with liquidity in the system, our borrowing costs will reduce.
Yeah. So just I want to add something. So as you said that liquidity is there in the market, ample liquidity is there. So we are getting benefited. And as you know, our cost of borrowing, especially incremental cost of borrowing, has come down below 7. That is, as of now, as on 30th June, it has come down to 6.97% only. And we are hopeful that in the next quarter, it will further go down by 5 to 2 bps.
Okay. And the last question is in my GNP and NNPA. If I go by the numbers, exact numbers, it is approx 400 to 500 crores increase in the GNPA if I'm right. And our NNP, I mean the provision is increased by 150 or 200 odd crores only. So is the another increase in GNPA is just for a technical write-off, or just because because of 1-2 days or 1 week there is a customer isn't there, and just for bookkeeping it came into GNPA number because of that? And how much recovery management is expecting for throughout the year, if you have a odd number in your mind?
Anash, our asset quality is improving gradually. If you compare with the Q1 last year, Q1, at time our gross NPA was 9,512. So if you compare with that figure, so it has now 8,115 only. And our asset quality is 2.62%. If you compare it with the previous year, corresponding quarter, it was 3.30%. So we are operating in the line in the correct way, and our asset quality improving gradually.
Yeah, yes, so my question was, is the GNPA is increased more than NNPA? So the difference between the both are just because of a bookkeeping, because customer didn't pay for 7-8 days and then it repays. But just for a bookkeeping for the 90 days period, it came in on to GNPA number as on the quarter one end. That was my question actually.
No. NPA ratio, yes, it has gone up slightly. If you look quarter to quarter, it was 2.47 at the end of Q4. Right now it is 2.62. Year on year, of course, there is an improvement. Partially because, yes, in Q1, I would say the NPAs, the stage 3 has gone up by 514 crores. Yes, we have witnessed some pressure on collections. Delinquencies in the retail, I would say, have been slightly more. But this has also been contributed by, I would say, a movement of personnel or resources, because the month of May for LIC HFL is a month of promotion and transfers. There's a lot of movement of personnel from place to place and from vertical to vertical. So probably because of that. But I am not worried. Usually Q1, this is a trend year after year, and Q1 is slightly slow. We do tend to recover in Q2, Q3, Q4. So I am sure that the asset quality will improve further going forward, and there should not be any such problems. Our PCR continues to be in that 50-51% bracket. So adequate provisions are in place. So there's nothing to worry as far as the NPA front or the stage 3 front is concerned. And
okay.
Current quarter, a write-off of only 30 crores of write-off was done. So it is not that we have significantly written off a big amount. You know, 30 crores in the current quarter.
Okay. That was from me. Thank you, sir, and all the best.
Thank you. We have our next question from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah. Hi, sir. Firstly, maybe you indicated not too much of pressure on balance transfer at this moment. But generally, in the past, we have seen that LIC Housing has the history wherein it comes in one quarter wherein there is a lot of repricing pressure, and we reset the rate lower, and then yields come off and decline in one single quarter. So how we are protecting ourselves against that kind of a risk? Because I think any which way competition is huge and we will see the pressure, and we have just cut PLR by 25 basis points. Yeah.
Yeah, Kunal, answering your question. As I said, right now we are not witnessing too much of a pressure, or I would say we are not witnessing any abnormal pressure. Yes, historically, you are right that BTs have been higher for LIC HFL. That means there is more business moving out than moving in the form of BTs. So the current trends, they continue to be at those same levels and are not alarming at all. So what we've done, yes, we have made a provision called rewriting of interest rates available to our customers. Any customer currently, say probably at 9.5%, can rewrite his loan at 8.75 if he wants. So we have made that facility available to the borrowers. Many of the borrowers are opting for that rather than transferring their loans. They are opting for rewriting. And the other part of it is, yes, there will be, because of the intense competition and the banks lending being linked to the repo rate, there will be pressure on us. We are aware of that. We have our teams in place. Our teams are monitoring every BT and trying to convince the customer to stay with us for various reasons. We're offering them additional loans, etc., etc., etc. But again, since the market is so competitive, it is all, at the end of it, it is going to be a big game of margins versus growth, right? So we as a company, we need to take a call as to whether we really need to grow the book at almost minimal or no spreads, or we need to protect our margins. And what I personally feel, given a push and a shove, and if our backs are to the wall, I would prefer to protect margins rather than look at growth. So that is what the strategy is at the moment.
So maybe fair to assume that then growth will also maybe continue to be very modest. In fact, a few quarters back, we have been indicating we would want to get towards double digit. But given maybe the focus on margins and this kind of a competition with banks being very aggressive, should one settle with maybe 7-8% growth for you?
Well, at the moment, Kunal, honestly, I am not indicating that. I am not guiding towards that. We would like to wait and watch in the second quarter what happens, what is happening, and then probably take a call, and maybe in the analyst call of Q2, I would be able to give you a better idea of what we are looking at, what numbers we are looking at growth. But I'm very clear in my mind that if at all it comes to choosing between growth and margins, I would choose margins.
Okay, got it. And last one on the overall yield breakup, you mentioned incremental yields are 8.9. If you can just highlight in terms of how the incremental yields have been in home loan and LAP. Yeah.
Well, I don't have the, Kunal, I don't have the breakup on home loans and projects, etc. Overall, I have this, what I gave you, 8.9 against 9.4 in Q4 of last year.
Got it. Okay. Yeah, no worries. Yeah, thank you.
Thank you. We have our next question from the line of Abhijit Tibrewal from Motilal Oswal Financial Services. Please go ahead.
Yeah, good afternoon, sir. Thank you for taking my question. So for the benefit of everyone just trying to understand, you took your first PLR cut of 25 basis points effective 1st April. And then did you share that you've taken your second 25 basis points rate cut effective 1st of July? Is that understanding correct?
Abhishek, we have taken only one rate cut across the board, 25 basis points, was on 28th of April. Now, since our book, 1/3 of the loans are on monthly reset, So immediately on 20th of April when we took it, they went on, the rates got for these one-third loans, the rate got cut on the 1st of June, right? 1st of June, yes. And 1st of May, sorry, 1st of May. 28th April was the date when the cut was taken. So from 1st of May, one-third of my book got reset. The other two-thirds of my book is on quarterly reset. So that got reset on the 1st of July. But there has been only one rate cut of 25 basis points across the board.
Got it, sir. So essentially speaking, in terms of PLR, we've just taken 125 basis points rate cut until now.
Yeah, that's correct.
Got it. And like you, spelled out earlier, sir, during the course of the quarter, if need be, we might look at further PLR cuts.
Well, yes, Abhijit, I'm praying every day that we don't need to cut further, but yes, as I said, we'll take a call as the scenario unfolds in Q2.
Got it. So the other question I had was around the asset quality. I'm just trying to understand right now, while this quarter we might want to call out the slippages that we saw as seasonal. You also alluded to the fact that, there are changes that happen at LIC Housing in terms of people movement, promotions in the month of May, which typically leads to some disruptions. But sir, what I'm trying to understand here is within the different product segments that you have, are you seeing more stress building up today in the LAP segment? And so why I ask is, of late we've been hearing that there is stress that is coming in the MSME segment, predominantly unsecured. But is there reason to believe that somewhere going forward, when people don't have enough money coming in from unsecured loans, they might gravitate towards this LAP product? And sir, to that extent, last 1 year, you will also acknowledge the industry has seen very strong growth in LAP. So are you also seeing now early signs of higher delinquencies in the LAP product? And sir, related question, if you could also share your segment-wise gross stage 3 that you share every quarter in the earnings call.
Yeah. Abhijit, well, if you look at CHFL, unfortunately, we don't have a big LAP book. Yeah? We are mostly into IHL, 85% of our loans in the IHL segment. The LAP segment hardly would contribute about 12 to 13% of my book. 11% of my book. So there is not too much of a LAP book. Whatever delinquencies we've noticed in Q1, my stage 3 EAD has gone up by 514 crores. Most of it has been in the retail and IHL segment, which is not significantly increased in the LAP or the LRD segment. So most of it is in the retail segment. Yes, I do agree. There has been some pressure on collections in the retail segment. This has happened across the industry. Yes, my competitors mostly were into the LAP and the LRD business. Maybe they are witnessing, like banks are witnessing in the MSME segment. They are witnessing some pressures in the LAP book. But no, our LAP book continues to perform as it is. Our worry or concern is in the IHL book, where most of the delinquencies have taken place in Q1. As regards the number, you are asking for the stage 3 numbers for individual home loans. Our stage 3 in IHL is about 1.22%. The EAD percentage 1.22%, and the EAD is 3,211 crores. What exactly, Abhijit, what are you looking for here? Do I give you the EAD?
So, sir, you can give the EAD, and so basically every quarter in the earnings call we share the segment-wise for IHL, NHI, NHC, non-housing individual, non-housing commercial, and project loans. The split we typically give the EAD in every earnings call.
Okay, you can note it down. In IHL, the EAD is 3,211.32 crores, and the EAD percentage is 1.2%. In NHC, housing commercial and projects, it is 3,497.77 crores, the EAD percentage is 24.82. In the NHI, it is 1,406.18 crores, and the EAD percentage is 4.25. And in the and the overall ECL, it stands at 8,115.27 crores with the EAD percentage of 2.62.
Got it, sir. This is useful. Thank you very much, and I wish you and your team the very best.
Thank you. Thank you.
Thank you.
Thank you. We have our next question from the line of Rajiv Pathak from GC Holdings. Please go ahead.
Good afternoon, sir. Sir, just two questions. One on the disbursement. So Q1 generally tends to be soft. But for the full year, what is the kind of disbursement growth that you are looking at?
Well, Rajiv, if you, in our Concall for Q4, for the guidance for the year, we had given a double-digit growth as the guidance, right? Q1, yes, it has been very, very muted. The growth has been on about, year-on-year, it is 7%. Q-on-Q, it is about 4.5%. So, yes, it is slightly muted, and as I said in the beginning, that sort of it being slightly low, largely to do with the rate cuts, and we being slightly slow in passing on the rate cut, probably. That is my assessment now, in retrospect, in hindsight. So that was one, and the other is, of course, the disturbance due to the movement of people from here and there. That does also contribute to a muted Q1 in LIC Housing Finance. Right now, I'm not in a position to give you any guidance, as I'm sticking to that double-digit growth guidance. Right? We'll wait and watch in Q2 how things unfold and how our growth picks up. I'm expecting growth to pick up in Q2. After Q2 ends, then maybe probably I'll have a relook at the guidance call of double-digit growth and come back to all of you and the markets with what I feel would be the growth guidance of LIC HFL for the entire financial year. Coming festival season coming up, this usually is a good season for all of us. And like in the past, we are hopeful of doing pretty well in the festival season.
Sure. So, sir, can you tell us the monthly disbursement that you have done in April, May, and June?
April, May, and June. Okay. April, it was 3,265 crores. May, it was 4,580 crores. And June, it was 5,125 crores.
Okay. So, basically, if you were to derive, so last year, I think we were at a monthly average of, say, 5,500 crores. Now that we have hit 5,000 crores plus in June itself, maybe this Q2 being better, should we take it to something like a 6,000 crore rupees of monthly disbursement average run rate? That would not be too far-fetched, right?
Should go up there. It should go up there. July has been about 5,500 crores.
Okay.
Right? So we should be, August onwards, we should be hitting 6,000, 6,500 crores every month. This will accelerate. Festival season, it will be higher. Festive season, it will be higher than that.
Okay.
And Rajiv, the figures conveyed by our MD and CEO, that is only retail.
Okay.
Yeah, 156 crores only in the entire quarter.
Sure. Sure. Got your point, sir. And sir, on the spread, so I think since we had this benefit of cost of funding upfront in this quarter, while the repricing of the yield was slightly going to be backdated because of the 1/3, 2/3 thing. So we had this spread improvement. But going into the next quarter, when you'll have 2/3 of your loan book getting repriced, do you think that the benefit of the cost of fund will be sufficient enough to cushion you?
Yeah, right now, as of June, our spread is 2.10%. And I earlier told that our incremental cost of borrowing has come down by 69 BPS. And in the coming quarters, we are expecting that it will further come down by 5 to 10 BPS. So in a nutshell, what guidance we have already given, that is between 2.6 to 2.80, we definitely will maintain that.
Okay, so means there's a possibility of 210 being maintained or even go up if you have this benefit on the cost of funds.
Yeah, maybe.
Okay, thank you so much and wish you all the best.
Thank you. We have our next question from the line of Ziswan Gao from Field Strategic Advisors. Please go ahead.
Hey, thank you for the opportunity. Just want to follow up on your earlier comment that for borrowers who want to BT out, we have made available, facilities allowing them to reprice at a lower rate. I just want to double check. Did I hear you correctly that, that they can reprice 75 bips lower if they chose to ask for it?
Yeah, Mr. Gao, it's something like this. Yes, not all our borrowers are at very high levels of rates of interest. Yeah, but borrowers trying to go out of our books, we are offering them this facility. This is available for everyone. It is not that this is a special facility available to only those who want to go out. This is available to across the board to all borrowers. Any borrower who right now has I would say a rate of interest, effective rate of interest of more than 8.75. We are offering them a rewriting at 8.75. So that is one of the tools we are employing to retain the existing borrowers who want to move out. The other thing is that since they've been with us for some time and we are aware of the property collaterals, the value of collaterals they hold. We are if required, if they're interested, we are offering them top-ups and loans on their property to hold them back. So these are some of the methods we are employing to retain customers rather than letting them go to competitors because of lower rates of interest being offered by the competitors.
And I want to add, So our business transfer, as you are asking, our business transfer is hardly 0.10% per month. Just looking to size our book, that is more than 3 lakh crores, 3 lakh 9,000 crores. So 1,000 crore in a quarter. So it is hardly 0.1% per month. That's all.
That's very helpful. Sorry. This new offering, when did it start? That anyone above 8.75 can opt for 8.75 rate.
Yeah.
When did we start this program? No, when did we start it?
It's already in vogue. It is already in vogue. We call it rewriting. So anybody as on date having a rate of interest higher than 8.75 can approach us, pay a small amount of fees, and get his loan rewritten at 8.75.
Got it. Thank you so much.
Thank you.
Thank you. We have our next question from the line of Chandrasekhar from Fidelity. Please go ahead.
Yeah, hi. I just want to know how much of the bank borrowings are repo linked and how much of them have a T+1 pass-through. Just trying to get a sense of how much of our entire 31% of our liability book has been repriced with the second 50 bits cut.
Yeah, so our 25% of total borrowing is EBLR, and in the current year, remaining 9 months, almost 22,000 crores of NCDs will be repriced. So if you take it bank borrowing plus repricing NCDs, the total book of around 42.96% would be floating, and the remaining 57% would be fixed.
Yeah, so have you had a T+1 pass-through on the entire 100 bits on the bank borrowing?
Yes.
Right. Okay. So you're not going to get much of an additional benefit on the bank borrowing side. Essentially, the delta is coming from the NCD side on a prospective basis.
So bank borrowing is already we already got benefit, and the incremental rate has come down by almost 69 BPS, and what we are saying that it will further come down by 5 to 10 BPS. So we are getting benefited on our existing borrowing from banks, and the scenario of more liquidity in the market, and we are getting benefited gradually.
Got it. Second, just how large is the TW pool, and there's any sense on how much recovery we may expect during this year?
Chandrasekhar, can you come again? I didn't get what you were asking.
Just how large is your TWO pool today?
Can you elaborate more?
Yeah. Return of pool, sir. Say a return of pool and just any sense on any recoveries, what's the broad estimation?
We already hardly return of 30 crores only in this quarter. And
No,
total
I'm
return
talking
of
about total return of
4,000 crores.
4,000 crores.
Yeah.
Any sense on what we could recover sometime this year?
So many cases are in pipeline, and we are expecting a good recovery in the coming quarters. And this quarter, we already recovered 60 crores.
All right. This last question, I think we last year, about 8-9 months back, started about an affordable housing, which is at 250 bits higher. Maybe some color on where we are in that process, how large a book, not just today, and just, it's still small, but in the overall context, but maybe over a year or couple of years, how large do you think that can become?
Well, Chandrasekhar, right now, we just started it last year in September onwards. So it's still in the process of, we are in the process of building up the infrastructure and the capabilities right now. We are not very aggressive on that, taking it slow and steady. This is a risky segment. We do not want to entangle ourselves in something which we would not like in future. So we are very much into this segment. We realize this is a segment which has the growth potential and also the margin potential. So we are going to get into it, but slowly and steadily as we build up our infrastructure and efficiencies. Right now it's pretty slow, but yes, there is some traction going on month on month. Last year, for example, about 458 crores of business came in from the affordable. And this year, not having a huge target or such, we would be happy with somewhere around about 1,000 crores and a lot more build up in the infrastructure and the capability.
Thank you.
Thank you. We have our next question from the line of Raman from Sequent Investments. Please go ahead.
Hello, sir. Can you hear me?
Hey, Raman. Good morning.
Good morning, sir. So I just wanted to, it's more like a clarification. Can you, you said you're expecting double-digit growth during the year. Is it AUM growth or the NIM growth?
No. We're talking about the disbursement, the book growth as well as the disbursement growth.
Okay. That's it. Thank you.
Thank you. We have our next question from the line of Koteshwar Rao from an individual investor. Please go ahead.
Hi, sir. Good morning.
Yeah, good morning, Mr. Rao.
Sir, you are discussing the new home loans at 7.5 interest rate, right? But how you are trying to reduce the home loan interest rate for the existing customers? Since in this year, RBI already reduced it by 1%, right? But your customers haven't get that benefit. How can the existing home loan customers get the benefit from LIC HFC?
Yeah. So, Mr. Rao, it's something like this. HFCs, housing finance companies, our business is very simple. We borrow money from the market and give it to you, individual home loan buyers, right? Right now, my cost of borrowing is 7.50. And you want to give it to you at 7.25. How is that possible? That is not going to be possible, right? So we do a monthly analysis of what my cost of borrowing is, what my cost of lending is, how much spread is needed, because it's not simple that I borrow at 7.5, I lend at 7.5, earn 0, and how do I manage my expenses and my overheads and various other things, right? So ours is linked to the PLR, the prime lending rate is what we call. We have cut it by 25 basis points for all customers. I do not know if you have not got it. You kindly see your statement for the month of July. You may be the quarterly reset customer. For you, it is applicable from the 1st of July. But we have cut it by 25 basis points across the board. And going forward, depending on our cost of borrowing, we will take a call. So if there is a significant reduction in our cost of borrowing, we will definitely like to pass it on to our customers.
Okay, sir. In this case, I just a small suggestion, and I try to reach out to branch manager and regional manager, and they don't have any enough info to clarify with the customer. And also, I see some of your agents are referring RBI rates instead of your own LPR rates. Okay, so it would be better if you discuss properly before discussing the home loans with the customers. And one more thing. If this same thing continues, okay, definitely banks will get the summit, right? Banks is offering with the better ROI. So why I need to invest in housing finance companies like LIC? In my case, I am the investor for LIC HFL and also I am the customer for LIC home loan. I took home loan, but I didn't get any benefit in the ROI change.
You must have got a 25 basis point cut, Mr. Rao.
No, sir. Actually, I took home loan on May, and I didn't get anything. And bank manager also don't know when you guys are revised the ROI. So I am in a dilemma.
No. May, if you got it in May 25, you would have got it at 7.5%.
No, sir. No. I got at 8.1 according to my. No. At that time, 8 is the starting. At that time, 8 is the starting one. I got at 8.1. But then they didn't revise it to as per your changes. I hope you understand.
No. Never had an 8.1 in rate. The rate of interest for individual home loan borrowers is dependent on the CIBIL score and other risk factors, right? So probably the rate was maybe the rate was 8%. You got it at 8.1 because of your CIBIL and other related factors. But then, and the cut was on the 28th of April, so you would have got the benefit of that. I do understand every customer wants that he should get it at 0% interest. I understand that. But we have a company to run.
Not like that. What I'm see.
Sorry to interrupt you, sir. May I please request you to rejoin the queue?
Thank you.
Thank you. We have our next question from the line of Abhijit Tibrewal from Motilal Oswal Financial Services. Please go ahead.
Yeah, thank you for allowing me a follow-up. So just trying to understand one small thing. If you look at your reported yields, it was 9.79, yes, as of March, which you reported as 9.6 as of June. So my understanding is this is based on period end, right? So these numbers are as of March and as of June. So first, is this understanding right? And the other thing I was just trying to understand, sir, is that if you look at your PLR cuts, you shared that you have taken a 25 basis points cut where 1/3 of the customers were on monthly reset. So this 19 basis points QQ decline that we have seen in the yields, right? Is it partly because of this 25 basis points rate cut and the remaining delta coming from the newer origination which are happening at lower rates? Is that understanding correct, or how should we understand this 19 basis points Q2 declining yields?
Perfect. Yeah, this is the cumulative 9.60 and 9.79 as at the end of last quarter. This 19 basis points is on the cumulative yield on advances. Yes, definitely the 1/3 cut, 25 basis point cut on 1/3 of our book, which came into effect from 1st of May, would have contributed to some of this, and the others would have been at the incremental lendings which we have done in the current financial year at near about 7.5%.
Got it. And so then, because effective 1st July, the remaining 2/3 of the customers will see a 25 basis points repricing. So that impact we will see in the second quarter results on the years.
Okay, right, Abhijit.
Got it, sir. This is the clarification I needed. Thank you so much.
Thank you. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
Yeah, thank you, friends. I believe we've been able to clarify most of your queries and your questions. As I said, Q1 has been quite flattish for us. Of course, traditionally it is a slow quarter for LIC HFL. As in the past, we have shown traction and growth moving into quarters 2, 3, and 4. This is what we are expecting in the current year. A slightly different market in the current financial year because of the rate cuts. Yes, the companies are under pressure, as Mr. Koteshwar Rao, an individual investor, alluded. Customers want the benefits of the entire rate cuts to be passed on. In some cases, not possible, like companies like HFL, because we have to do business. We are a company. We have to borrow and lend. So it depends on borrowing rate. But looking forward, we expect everything to pick up, the growth momentum to pick up, the activity in the markets to pick up. Of course, I do understand competition also will pick up because banks are very, very, very aggressive. But 36-year-old company, I think we are poised to take on the market, poised to take on the competition and do ourselves and do well for us. Q2 is going to be a defining quarter for all of us. That will set the course for the financial year. So looking forward to meeting you all at the Q2 conference call and sort of explaining our performance as well as our way forward. Thank you all for your support.
Thank you. On behalf of Axis Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.